loan, say it is 50 lakh rupees worth of a home loan, and you took it out for 20 years before May last year, before May of 2022, then your EMI would have been 38,000 rupees a month. Now it stands at almost 45,000 rupees a month. This has happened after all the rate hikes, about 225 basis points of rate hikes that we've experienced in 2022. As far as the economists go, and the ones we've been speaking to, they agree that the RBI will once again hike interest rates, this time by 25 basis points at least. That's the word that we've got. The reason is that the volatile food inflation has come down. It has come down, and of course, the RBI is happy about that, we hope. But the core inflation, that still remains somewhat sticky. So the question is, should the RBI go ahead with the kind of interest rate hikes we've seen in the recent past? In which case, the EMI is going to rise yet again. But here's a lowdown on the RBI's expected move. As far as the economists we've been speaking to, let's find out where expectations are pegged this time. All eyes on the MPC meet, which ends tomorrow. Economists, like I told you, are predicting a 25 basis points hike in the policy rate this time. And they're also expecting a switch of stance. Currently, the stance is withdrawal from accommodation. Will it become a different kind of take or not? That remains to be seen. To neutral, the stance is likely to change. Let's find out where expectations are pegged. Harsh, my colleague, is joining us with expectations from the meet tomorrow. Harsh, do tell us where expectations are pegged with all the economists we've been speaking to.
So we're definitely expecting a hike in the interest rate. That is set to continue. Of course, the question is by how much, and the expectation is it's going to be increased by around 25 basis points. Let's also talk about the stance, right? I mean, largely the stance has been a withdrawal of accommodation. That's broadly the stance adopted by the RBI. But there seems hopefully to be a shift to that stance, to a neutral stance, because we've seen inflation come off. And let's talk about some of those aspects as to what to look out for. Well, in terms of where global markets are really moving, pretty much every central bank across the globe continues to hike rates, and that will keep some amount of pressure on the RBI as well. We will see the RBI continue to defend the rupee in that attempt where other central banks are largely raising their interest rates. With regard to commentary, we are expecting, of course, a commentary on growth going forward. We did see advance estimates come in at 7%. The currency, which has depreciated quite a bit, and despite the dollar depreciation now, the Indian INR, which is the Indian currency, has not really moved much. So one piece around that will be of a little bit of concern with regard to where the RBI is really seeing it, and global recession risks is the other factor. In terms of where inflation is, RBI expected it to come below that 6%. Now this is the first policy where for both the months, December as well as November, the inflation number has come below the 6% band, which is the upper tolerance band of the RBI. So commentary around that will of course hold the key. With regard to, let me compare versus the December meeting versus now. Let's try and understand as to where the macros really stood at. Crude was largely at $82. Currently, more favorable is where the crude prices are at. We're looking at the 1-year USD to INR seeing a slight bit of depreciation. We're also seeing the US 10-year yields slightly higher, the Indian 10-year yields following that. But the real key metric here is the CPI inflation. It was at 6.8%, it's come down to 5.7%. And that is something that the RBI will be talking about, hopefully. Largely it's been a declining trend. It's been a consistently declining trend when it comes to CPI inflation, and that's a positive. Where global or GDP growth is concerned, India, of course, standing out among the global peers, but the Indian GDP growth in Q3 and Q4 as expected by the RBI is around sub 4.5%. Any revision to that will also be looked out for. But largely, it's going to be a more tempered, increase in the repo rate. That's the expectation.
Tempered growth when it comes to the repo rate. Thanks, Harsh, for filling us in on expectations. But let's just get perspective on this from the experts. Shweta Rajani is joining us. She's head of mutual funds at Anand Rathi Wealth. And Garima Kapoor, Chief Economist at Elara Capital, is also joining us. Great to have you, ladies. Garima, first to you. You know, inflation, as we are hearing and reporting, it's softening everywhere, including here in India. Like the Fed, do you expect the RBI now to go easy on interest rate hikes, starting with the announcement tomorrow, or is it going to take longer?
I think the backdrop of tomorrow's policy is clearly that compared to RBI's own expectations of 6.7%, we're likely to see an undershooting. Last 2 months' prints have been quite favorable on the headline front, led by food and partly by base effect. Although it's not been a very merry news when it comes to core inflation, but in the backdrop of the fact that India's growth, especially drivers when it comes to consumption, when it comes to rural consumption or even discretionary consumption, incremental data has not been as favorable as it was a quarter ago or a couple of quarters ago. I think in this backdrop and the backdrop that global economy is slowing, not materially and not as much as we'd anticipated a quarter ago, but it is still slowing compared to what we were seeing about 6 months ago. I think it only makes a favorable case for RBI to hike rates by 25 basis and then put a pause, taking into conjunction the fact that your core inflation remains sticky, although the headline is sub 6. But key thing to watch out for, in my view, Vikram, is going to be what is going to be the change in stance, whether or not RBI changes stance, and that could actually drive market expectations of what the future trajectory would be.
Fair enough. Accommodative to neutral, whether that's going to happen or not. Shweta, what do you think? Since the rate hike cycle started after this 2-year lull that we had in interest rates, the RBI, of course, was making that all-out effort to hold back rising inflation. Has now, as far as RBI is concerned, they've raised the repo rate by 225 basis points. Totally, if you look at the kind of hikes we've seen in recent times, if you add that all up, it seems that most banks have already passed on around 200 basis points hike to home loan borrowers to date. How tough has it been on them, in your opinion, to home loan borrowers? Is there room, you think, for further hikes in home loan EMIs?
Absolutely. Like you rightly mentioned, what we have seen in the last few months is that, banks clearly from 2019 have been following the, floating rate pattern, which is repo rate plus kind of a model for setting the home loan rates. And in the last few months, 200 bips out of the 225 bips have already been passed on to the home loan buyers. What we have seen in terms of its effect for a long tenor loan, the EMIs have gone up by 20%. For a slightly shorter tenor of home loan, the EMIs have gone up by 10%. Now, this is the impact for an existing investor or existing home loan buyer. For people looking to buy a home loan, there was this report which came in from Knight Frank, which showed that after the December rate hike, the affordability index had already been impacted by 3%. Moreover, when we are looking at the unsold inventory in the key cities, that stands at 40 months, and that's been inching up month on month in the last few months. So all this is clearly reflecting that there has been a significant impact on the home loan buyers, whether existing as well as new investors deciding whether they should go in for their home loans or no. In fact, what we have seen is, home loan buyers looking at prepaying some of their loans wherever there is some liquidity available, so that the EMI impact can come down. We have also seen instances where buyers are looking at extending the tenors so that they don't feel that pinch in their pocket where the same EMI is going, only the tenor has gone up. In our view, I think with the 25 bips of repo rate hike expected, home loan borrowers can expect some more pinch to their pockets. So maybe another 25 bips can get transferred, and that will have a negative impact on the EMIs.
So more pain ahead, that's what you're indicating, and that's never good news because, yes, we've had transmission because out of 225, we're saying 200 bips has already gone through, and perhaps more interest rate hikes announced by the RBI on repo rates could mean even more pain for the home loan borrower. Garima, the budget has maintained a virtually unchanged borrowing program. The survey, the economic survey, pointed to the persistence of higher interest rates in the coming year. What do you think are going to be the RBI's cues from at least these two documents of data for their positioning on further interest rate hikes this month and beyond. In fact, especially if the mood is to spur sustained growth now, like the finance minister has underlined in her conversation with us right here on ET Now. What do you think is going to be the takeaways for the RBI? What are the cues that they are going to take away from the union budget, what the centre is hoping to do, and what came out in the economic survey?
Vikram, in the economic survey, I think by indicating that they expect or the everybody should be bracing for prolonged steady rates. I think the hint was more towards that. Although you could see a pause in the rate hike trajectory, you should not anticipate a cut anytime soon. Remember, sub 6%, 2 consecutive months of reading are enthusing us, but at the point in time, your actual target is going to be a midpoint target for RBI's inflation targeting is 4%. And unless and until there are credible signs that on sustainable basis inflation is going to come down to a level of 4%, which is unlikely until your core inflation corrects materially, and that looks fairly sticky now going by the pricing power that you've seen for services, I think you will see a prolonged period, or at least through the current next financial year, interest rates remaining steady where they are. I think that's what probably economic survey was indicating. But if I was a central bank and if I was an MPC committee and I was looking at and taking cues from what's really come out in the budget, I'd be extremely happy with two things. One is that the focus of the mandate of this fiscal consolidation has not been compromised, despite it being a pre-election full-year budget. Second is that the pattern of spending or the quality of spending has incrementally moved more and steadily towards capex, which is even more encouraging. And third is that there has been an element to cut back subsidies. So if I was a central bank looking at the fact that are there any cues or any drivers that could be further inflationary from the budgetary spending point of view, I think I'll be fairly happy. And I think that conservative approach of the finance minister will actually bode very well for RBI when NPC when it comes out for decision making. I think it should have been one of the key drivers of why they probably will take a relief from the budget, or when they would have met it since yesterday and will announce their policy decisions tomorrow. So I think a thumbs up from the MPC side to the budget.
Yes, there would be. But, another side would actually say, Garima, that now that we're looking at the kind of capex plan that has been revealed, it could perhaps stoke inflation. It has been doing the rounds this entire debate. Shweta, keeping in mind capital flows into the economy as well, also where the rupee currently holds against the US dollar, when do you believe the RBI is going to hit the pause button on rate hikes? Will it be now or the next one? I asked Garima this. What do you think? How do you suggest that new home loan borrowers now strategize in either case, whether it's going to happen now or a little later as far as the pause is concerned? How do you think? Because the pinch, like you said, is coming.
Absolutely. So, in my view, that this could be the last of the rate hikes that they do, and a very small probability that they may pause it in this cycle as well. But a high probability event that we would see a 25 bips of rate hike, and post that we may see a pause coming in, which is where also from a home loan buyer perspective, they could see another 25 bips of increase in their borrowing rates. After that, we could see some easing off, or some stagnation where they will not see a rate hike impact on their loan rates. In my view, RBI would then get on to a wait and watch mode and see where the inflation numbers are heading, as well as where the economic growth is going. Because at this point of time, they're going to be balancing off. Inflation worries have cooled off because of your CPI coming in, at least the last two prints at sub 6. Growth worries do remain, when we're looking at the global recessionary trends. So they'll pause it after one more repo rate hike is my view.
How do you think new home loan borrowers right now should strategize? Could you tell us quickly what you think they should do?
Absolutely. So for a new home loan buyer, like I said, this can be a good time to go ahead still with your purchases if you have to do, because most of the impact we've already seen. And go in for a longer tenor of loan at this point of time, because it's sitting at that peak of the rate hike cycle most likely. So from your own, you could only see your floating rates coming down and therefore the EMI effects coming down. The other option that one can do is, go in for a long-term home loan rate. At the same point of time, if you have investments or liquidity available, what you can do is invest in an instrument or have a strategy in place which is giving you returns which are more than that 9.5% that you're paying as your home loan. So you're not setting off the impact over there. Your existing investments you've invested which are giving you more than the home loan rate. You've taken a loan which is long term, so the interest that you're paying off more or less is being setting off from this, as well as because you've taken a longer tenor loan, you're also getting your tax benefits to a certain extent. So that would be my suggestion to a new home loan buyer.
I'll be able to appreciate this. Shweta and Garima, this is a question that I've had about, the RBI keeping pace with interest rate movements elsewhere. Because, yes, we've heard from the Fed, the Bank of England, the European Central Bank. How important is it for the RBI to be in sync with what the other central banks, the leading central banks of the world are doing?
No matter what one would say that you are probably de-linked, decoupled, and that you had a relatively stable inflation regime this time around compared to the world, I think what global central bankers do, especially led by the three large central bankers, will tend to play on the mind of the central bankers. Now, there is a catch in there that until about the recent employment number from the US, everybody was probably within the market anticipating there to be a 25 basis another hike from the Fed and thereabouts. However, the recent incoming data, including certain PMI services, actually thrown in the open that particular presumption, because that clearly tells you that despite the consecutive rate hikes by Federal Reserve, the economy in the US remains fairly strong and resilient. The markets also have been performing fairly well. Now, in that context, probably rate hike expectations might get somewhat readjusted. And I think that would play on the mind of RBI. And hence, I do think there is an outside chance that although they might hike now, there could be a chance that they might not want to change the stance right away, because that leaves the room open for maneuvering in the future. And two, what if if the rate hike trajectory globally being more prolonged than what you earlier anticipated? And secondly, in case core inflation does not correct materially, it leaves room open for you. So I would accord that a small probability for sure.
Fair enough. So we've got all of that in perspective. The possibility of a change of stance also remains on the radar. We'll see whether or not that happens from this accommodation, withdrawal of accommodation to a neutral stance. That's something else we're watching out for. And of course, whether there is going to be some relief for home loan borrowers. And they've had it pretty rough in recent times. We lived in inflationary times. It is petering off, but how much of that is going to reflect in the RBI's next policy remains to be seen. Garima and Shweta, such a pleasure getting your perspective in on this edition of India Tonight. Thanks very much for joining us. Meanwhile, we are taking a look at the Indian markets, how they performed in today's trading session. After starting on a flat note, the benchmark indices have ended lower.